Welcome to the Lord Munjal Show, where Alpheva is building the financial operating system for high earners, continuously finding what you're leaving on the table across taxes, investments, debt, and insurance. We all have this fantasy early on in our careers, right?
Oh yeah, the magic autopilot fantasy.
Exactly. We convince ourselves that if we can just reach a certain level of income, all the financial stress will magically evaporate.
Like your money is just going to sort itself out.
Right. But
But
if you are listening to this, you've probably collided headfirst with the great irony of wealth. I mean, making more money does not simplify your financial life.
no, for high earners, it does the exact opposite. It's the ultimate paradox of success, honestly.
It really is. You put in years of grueling work to build this wealth, and suddenly you wake up and realize, wait, I am now the unpaid CEO of a highly complex, disorganized enterprise.
And you're juggling, scattered logins, equity compensation, restricted stock units, vesting schedules, all of it.
Overlapping insurance policies, complex debt structures, and you probably have a great team, right? A seasoned CPA, a sharp financial advisor, a meticulous estate attorney.
Yeah, you've assembled the all-star team. You are doing everything right, and yet
There's that nagging feeling.
exactly. That persistent feeling in the back of your mind that something is quietly being missed.
You review your quarterly statements, you sign your tax returns, but you just know the machinery isn't running at full capacity.
Well, I want to validate that feeling right now because it is not paranoia. The leakage happening in your financial life is rarely a massive, catastrophic blunder.
Right, you didn't fall for a phishing scam or bet your net worth on one stock.
No, the value is leaking
Yeah.
through the friction between good choices. It's the invisible collision of completely reasonable decisions interacting in the shadows.
Okay, let me push back on this right away because I can hear the skepticism from our listeners. If you were paying a premium for an all-star team, shouldn't those shadows be illuminated?
You would think so.
Right. Isn't looking at the big picture the literal job description of a high-end financial advisor?
I mean, that is the logical assumption.
Mm.
But it ignores the reality of how the wealth management industry is actually built.
Yeah.
This is a structural problem, not a talent problem.
What do you mean by structural?
Well, your professionals are likely incredibly skilled, but they are engaged strictly by specialty. They operate within walled gardens defined by their specific scope of work, their pay, and honestly, most importantly, their professional liability.
Oh, right. Their malpractice insurance only covers them for their specific lane. A CPA can't legally give you investment advice without stepping out of bounds.
Precisely. And the attorney drafting your estate plan is certainly not going to monitor your daily portfolio volatility. So they live in silos.
The CPA owns tax, the advisor owns investments, the attorney owns legal.
Exactly. And the moment a financial decision crosses from one silo into another, the system breaks down.
I want to break down how that actually happens in practice, because the mechanics here are fascinating. Give me an example of the tax and investment silos colliding.
Okay, a perfect example is tax loss harvesting. Your financial advisor looks at your portfolio, spots an asset trading at a loss, and sells it to offset gains elsewhere.
Right, totally standard.
In a vacuum,
Yep.
inside the investment silo, that is a textbook, highly efficient move. But let's say you are a high earner receiving equity compensation.
Like restricted stock units.
Right.
And those RSUs are usually held on a completely separate corporate platform like E-Trade or Morgan Stanley that your primary advisor doesn't have access to.
They don't see it, and frankly, they might not even know the vesting schedule. That blind spot is where the damage happens.
Oh, wow. Okay.
So your advisor executes the tax loss harvesting by selling shares of your company's stock or an overlapping fund. Meanwhile, completely out of their view, a batch of your RSUs automatically vests on the corporate platform.
Right inside that same 30-day window, which triggers a wash sale rule.
Exactly.
Because the IRS says if you sell an asset for a loss, but buy the same asset within 30 days, you forfeit the deduction. And a vesting RSU counts as a purchase.
You lose the deduction entirely. The advisor thought they were saving you money, but because they couldn't see the equity comp silo, the strategy collapsed.
And the CPA. They won't discover this wash sale until the following spring, right?
Right, when they are staring at your tax documents long after the window to fix it has closed, they are basically doing an autopsy on a decision that needed preventative care.
It is maddening. Everyone did their job perfectly, but the household still loses. To really grasp why this happens, a great way to visualize this mess is to think of your financial life as a sprawling, rapidly growing city.
I think about that metaphor constantly. As your wealth grows, you stop managing a single building and you start managing a metropolis.
Right. And the city is divided into highly distinct districts. You have the tax district, the investment district, the debt district, insurance, estate planning.
And the crucial thing about these districts is that they do not share the same local laws. The tax specialists know every alleyway in their own district, but they never cross the border.
But your financial life doesn't respect district boundaries. Life events act like traffic flowing through this city. Let's say you decide to buy a new primary residence.
Right. That decision does not stay neatly contained in the real estate or debt district.
It causes a massive traffic jam that cascades across the entire map.
It ripples everywhere. To fund the down payment, you might need to liquidate assets in the investment district, which instantly triggers capital gains in the tax district.
Exactly.
And taking on that new mortgage alters your liability profile, which means your life insurance coverage in the insurance district is suddenly inadequate. Plus, how you title the property impacts your estate planning district.
But there is no central traffic control system coordinating the lights. The insurance broker doesn't know you bought the house until you happen to mention it.
Nobody tells them. And compounding this traffic jam is the reality of severe data fragmentation. The literal infrastructure of our financial city is broken.
Yeah, think about the underlying data. Your legal trust is a 60-page static PDF document. Your investment portfolio is a live data feed on a brokerage portal.
And your tax returns are historical forms sitting in a CPA's secure vault.
You are dealing with completely different languages. A legal clause cannot automatically talk to a live data feed from a bank.
Which means mapping the city requires a human being to download PDFs from 5 different portals, securely email them to 3 different professionals, and hope someone connects the dots.
Keeping that map current is a grueling full-time job. And let's be honest, nobody is actually doing it.
No. You might build a massive spreadsheet on a Sunday afternoon in January, but by February, the market has moved, your RSUs have vested, and the spreadsheet is obsolete.
The city cannot function if no one is accountable for the entire map.
It creates a massive coordination gap. And the space inside that gap is where high earners lose incredible amounts of wealth.
Okay, let me play devil's advocate for a moment. I can hear a listener thinking, sure, this sounds highly inefficient, it's annoying, but are we just talking about optimizing the margins here? Does this actually move the needle?
Oh, it moves the needle drastically.
Yeah.
The danger of the coordination gap is its deceptive nature. Like we said, it's rarely one explosive event. It is a slow bleed.
Death by 1,000 paper cuts.
Exactly. It's a compounding series of unforced errors that quietly drain your net worth year after year. Take the debt district, for example.
Yeah, debt is so often viewed in total isolation.
It is a massive leak for high earners. When you evaluate a mortgage or a large loan in a vacuum, you almost always end up with debt priced way above the alternatives available to you.
Right. An executive wants to buy a vacation home. They take on a standard loan, creating a heavy monthly drag on cash flow.
Meanwhile, they're sitting on a highly appreciated investment portfolio.
Nobody looks at the whole board and says, hey, we can structure a margin loan or a pledged asset line against your portfolio.
Right. You avoid realizing capital gains, you get a highly competitive borrowing rate, and you leave the assets invested to grow. But the mortgage breaker can't see the investment portfolio.
And what about the insurance district? This feels like the ultimate set-it-and-forget-it trap.
Insurance drift is a critical vulnerability. As high earners progress in their careers, their wealth scales, but their liability protection rarely scales with it.
You end up with hidden gaps. You remodel your home, join a nonprofit board, and drastically increase your personal liability.
But your umbrella policy still reflects the net worth you had half a decade ago. You're walking around completely exposed to a catastrophic lawsuit.
Assuming you are fully covered just because you pay a premium every month.
Or you have the opposite problem, duplicate coverage. Overlapping policies from different employers, and you are literally throwing premium dollars into the incinerator for zero added benefit.
Wow.
But honestly, perhaps the most costly leak of all comes down to a single factor: timing.
Missing the window.
The December 31st cliff. So many sophisticated tax planning strategies, charitable block strategies, backdoor Roth conversions, specific loss harvesting, they evaporate the moment the year closes.
And the coordination gap means your CPA only discovers these missed opportunities in March or April. The opportunity is gone forever. Let's ground this in a cohesive scenario. Imagine a dual-income family in Silicon Valley. One partner is a tech executive juggling a complex multi-year equity vesting schedule.
Yeah.
They have a jumbo mortgage. They are trying to fund 3 separate college savings accounts, and they are navigating the tax implications of living in a high-tax state.
The sheer volume of interacting decisions for that household is dizzying. When those companies' shares vest, do they immediately sell them to pay down the mortgage principal?
Or do they hold the stock, assuming it will appreciate, and instead refinance the debt?
Right. And if they sell, how does that sudden spike in taxable income impact their eligibility for certain deductions?
When you look at any one of those choices in isolation, a slightly inefficient interest rate, a missed backdoor Roth, a wash sale penalty, it looks like a minor friction cost.
But when you layer those inefficiencies on top of each other and repeat them across a decade of vesting events and life changes, the accumulated cost to high earners is staggering.
The only way to calculate and prevent this impact is to evaluate the entire system simultaneously. Which brings us to the most obvious question.
Why hasn't this been fixed before?
Exactly. If this slow bleed is so significant, why is this still a problem for incredibly successful people?
Because historically, solving this problem required an exorbitant amount of human capital. A true whole system view did exist, but it was packaged as a family office.
The billionaire approach. You hire a literal CEO for your household.
You build a dedicated full-time staff, a chief investment officer, and in-house tax counsel. Their entire job is to sit in a room, look at the whole map of the city, and connect the dots.
But maintaining that infrastructure is astronomically expensive.
It was a luxury strictly walled off for the ultra-wealthy. Everyone else, no matter how high their income, was forced to accept a fragmented advisory experience.
But the landscape is fundamentally shifting now. We are talking about a massive paradigm shift in how this gets solved.
We are experiencing 3 distinct technological game changers that are democratizing the family office capability. The first is AI's capacity for continuous monitoring.
Right, because in the past, a human being had to manually pull your statements once a year.
It was just a static snapshot. Now, advanced AI can evaluate complex relationships across multiple domains 24/7. As market conditions fluctuate, the technology is constantly calculating the impacts across your entire financial city.
And we have to talk about how it actually does this, because large language models, or LLMs, can now actually read and comprehend the unstructured text of a 60-page legal document.
Exactly. They extract the specific rules of your trust, translate them into structured data, and automatically cross-reference them against the live data feeds from your investment accounts.
Which brings us to the second game changer, modern data connections.
The proliferation of secure financial APIs means we can now automatically pull your checking, brokerage, credit card, and loan data into one unified ecosystem.
The infrastructure of the city is finally connected. The traffic lights are talking to each other. You don't have to spend your weekends wrestling with pivot tables anymore.
And the third game changer is proximity to execution. AI pushes the analysis right up to the edge of action.
Because identifying a tax loophole is utterly useless if you find out about it in April.
The technology flags the opportunity in real time, allowing you to weigh the trade-offs and execute the strategy well before the window closes.
I am looking at all these pieces, the continuous monitoring, the API connections, the real-time alerts, and what we're really talking about is the creation of a true financial operating system.
Yes.
You have technology processing the whole picture at a scale humans can't match. But, and I want to emphasize this heavily, it is paired directly with licensed human advisors.
That synthesis is the exact formula for success. AI handles the massive computational heavy lifting of finding the hidden connections.
And the humans apply the irreplaceable judgment regarding your family values, your risk tolerance, and your long-term goals.
When you fuse elite machine intelligence with human empathy, you completely close the coordination gap.
Which brings us directly to the solution that is fundamentally rewiring how high earners manage their wealth. It is the natural, inevitable answer to this entire systemic failure we have been unpacking. That answer is Alpheva.
It is a brilliantly executed approach to a massive problem. Alpheva is literally building this exact financial operating system for high earners.
They provide a single connected view across your taxes, your investments, your debt, your insurance, and your estate planning.
They deploy advanced large language models to continuously monitor your entire financial city, actively identifying exactly where you are leaving value on the table.
And then, crucially, they pair that AI layer with licensed human advisors who review the technology's findings and guide you through execution.
The mission is incredibly compelling. Democratizing the institutional-grade insight that was previously locked behind the doors of ultra-wealthy family offices.
And when you look at the leadership, the vision makes perfect sense. The founder is a multiple-time founder and the CEO of Alpheva AI. They bring a uniquely deep background bridging AI, fintech, sophisticated product design, and strategic CXO roles.
They have a proven track record of scaling digital platforms.
But what truly anchors this platform is their core philosophy. AI should elevate human capability, not replace it, blending intelligence, empathy, and total transparency.
It represents the inevitable future of wealth management. If you are a high earner today, there is simply no longer a justification for accepting fragmented advice and bleeding value in the shadows.
To be clear, this doesn't mean you have to fire your trusted specialists. Your CPA can continue filing your taxes. Your attorney can continue drafting your legal documents.
But you absolutely require that intelligent layer operating above them coordinating the entire system.
Just a quick note for our listeners to keep the legal team happy. Our discussion today is purely educational. It is not personalized financial, tax, or legal advice, and individual results will always depend on your specific personal circumstances.
Absolutely. But before we go, I want to leave you with a final provocative thought, a challenge for you to test everything we've discussed today.
Oh, I like this. What is it?
If you have more than one financial professional in your life right now, I want you to ask them one simple question tomorrow. Ask them, when did you last speak directly with my other advisor?
I can already guess the response.
The answer is almost universally never. And that silence you hear, that is the sound of the coordination gap.
Wow.
Closing that silence doesn't mean starting over. It means finally installing the operating system that allows your entire financial city to thrive.
Check out alpheva.com.